You bought a call option. Nifty moved up 150 points. Your direction was completely correct. But when you checked your P&L, your option had lost money. Or maybe it made a tiny profit that didn't feel worth the risk you took. You sold in frustration. And somewhere in your head you thought, is the market rigged? Are brokers doing something? Is options trading even real? It's not rigged. But you were playing a game with rules you didn't fully know yet. Today I am going to show you 3 common reasons this happens and a framework to think through before you buy any option. When you buy an option, you are not just buying direction. An option's price is made up of two parts. First, intrinsic value, how much the option is worth if the contract expired right now. Second, extrinsic value, also called time value. Everything else, how much time is left on the contract and how much volatility the market is pricing in. When you buy an out-of-the-money option, it has zero intrinsic value at the time of purchase. The entire premium you pay is extrinsic. So even if the stock moves your way, the extrinsic value can be shrinking faster than intrinsic value is building up. Here are 3 common reasons this happens. Theta is time decay. Every day that passes, your option loses some portion of its extrinsic value, even if the underlying doesn't move at all. This is not an edge case. This is a structural feature of how options work. An option expiring in 7 days decays far faster per day than one expiring in 30 days. The closer you are to expiry, the more aggressively theta works against the buyer. When you buy an option, time is not neutral. Time is your opponent. Before important events, earnings announcements, RBI policy decisions, union budget, traders expect big moves. Implied volatility rises, inflating option premiums across all strikes. The moment the event is over, that uncertainty is resolved. Implied volatility drops sharply, sometimes 30, 40, even 50% in a single day. When IV drops, the extrinsic value of your option collapses, even if the underlying moved your way. This is called IV crush, and it catches a lot of option buyers off guard the first time they experience it. An out-of-the-money option requires a large enough move in the underlying to build meaningful intrinsic value. But here is something important to understand about break-even. When we talk about the expiry break-even of a call option, that is the strike price plus the premium paid. If you paid 150 rupees for a 24,200 call, your expiry break-even is 24,350. That means if Nifty is at 24,350 at expiry, you break even. Below that, you lose. But, and this is a key point, you do not have to hold until expiry to exit profitably. Before expiry, your option still has extrinsic value. If the underlying moves strongly in your direction quickly, the option's market price can rise enough to give you a profitable exit even before reaching the expiry break-even. The expiry break-even tells you where you need to be if you hold the full contract, but most option trades are closed before expiry. What matters is whether the option's market price rises enough for you to exit at a profit, and that depends on the combination of direction, time remaining, and IV at the time of your exit. Let me show you with an illustrative example. Nifty is at 24,000. RBI policy announcement is tomorrow. You are bullish. You buy a 24,200 call option, 200 points out of the money. Premium paid 150 rupees per unit. Nifty lot size used here is 65. Please verify with your broker as this is time sensitive. The RBI announcement comes. Nifty moves up 150 points to 24,150. You open your terminal expecting a profit, but your option is trading below what you paid. What happened? Your 24,200 call is still out of the money. Nifty at 24,150 has not crossed the strike. So intrinsic value, 0. The event is over. The uncertainty that was inflating your options premium is gone. Implied volatility has collapsed. Your extrinsic value has been hit by IV crush. One full day has also passed. Theta has taken its daily erosion. The stock went up. You were right about direction. But these 3 forces, time decay, IV collapse, and insufficient move relative to your strike, worked against your position. Before buying any option, work through 3 questions. Question 1. What volatility am I paying for? Look at the current implied volatility. Is it high or low relative to recent history? A high IV means a larger portion of your premium is extrinsic and more of it is at risk of collapsing. This does not automatically mean you should not buy. It means you should understand what you are paying for. Question 2. How far does the underlying need to move for my trade thesis to work? Calculate your expiry break-even. Strike plus premium paid for a call. How realistic is that move given your time horizon? And remember, if you plan to exit before expiry, what price increase in the option are you targeting as a profitable exit? Question 3. How much time does that move have to happen? A weekly expiry with 4 days left has aggressive theta working against you every day. A monthly expiry gives you more time, but you pay more premium for that time. The question is whether the time you have is realistic for the move you are expecting. IV tells you what volatility you are paying for. Required move and break even tells you how far the underlying needs to go. Time to expiry tells you how long you have for that move to happen. These 3 together form the basis of evaluating any option buy. None of them alone tells the full story. 3 things to remember. 1. Getting direction right is necessary but not sufficient for an option to be profitable. Time, volatility, and strike selection all affect the outcome. 2. IV crush after events and theta over time can cause your option to lose value even when the underlying moves your way. 3. Before buying any option, work through what am I paying for in terms of volatility? Where does the underlying need to go? And how much time do I have? If this is a situation you have experienced or want to understand more deeply before it costs you, subscribe to the 3 p.m. Trader. Every video here is focused on practical F&O education, real situations, risk first, process over prediction. I will see you in the next one.